Lending 101, we're going to go through some acronyms that a lot of people have heard of, but you may not understand really what they mean. So the first one, we hear this all the time, ARM. That was the dreaded thing that caused the 2008, 2009 crash, right? Not really, but it did have some participation in that for certain. Adjustable rate mortgage. Adjustable rate mortgage means that, unlike in a 30-year fixed, where it's fixed, that the interest rate is fixed for a predetermined period that's dictated on the mortgage note. In this case, a 30-year, the interest is fixed for 30 years. Unlike that, you may have in an adjustable rate mortgage, you may have a mortgage term that is 30 years, but during specific and predetermined points of the mortgage, it will adjust to whatever the market rate of the interest is at that period. So for example, if we start today, let's say that your interest rate is at 4%, and you're on a 5-1 ARM, that means that in the 5th year, it's going to reset from 4% to whatever the market rate is at that time for one more term of a year. So that's where the 5-1 comes in. So it can adjust up and it can also adjust down depending on what the mortgage rates are doing at that particular time. Second, PITI. Now, this one certainly a lot of people have heard of, but they may not understand what those acronyms stand for. Principal, interest, taxes, and insurance. If you go out to some of the services that are out there that quote you interest rates, bankrate.com for example, they'll give you a principal balance, they'll give you an interest rate, and they'll give you a term. What they don't typically give you, because in most cases they don't know, is the taxes and insurance. And so when you go into your mortgage advisor and he says your payment's going to be $900 a month, and you go, that's $300 more than than Bankrate had told me. It's not always a product of the interest rate being different. Usually what that is that your mortgage advisor, because he's smart, is giving you the full payment with taxes and insurance in there as part of your escrow payment. That's most likely the difference. The last one is mortgage insurance, or MI. Some folks hear this as PMI. They hear it as upfront mortgage insurance or upfront MI. Basically, it all wraps into the same bundle. Banks only want to lend you 80% of the value or the purchase price of your home. That's all they want to do. So if you're buying a $100,000 home, they only want to give you $80,000. Well, for most of us, if we don't have 20% down, we've got to figure out a way to bridge the gap between the 80% and the 100% purchase price. So mortgage insurance companies will come in and they'll insure the bank the 20% that they don't want to lend. If they'll lend over, there's a policy that comes out for that 20% that you paid the monthly premium, but the bank is the beneficiary. So each month you make a payment so that in the event that you have to be defaulted on because you don't make your payments, the mortgage insurance company comes in and now covers that for the bank.